With all the volatility in the markets right now, you may be better in an index-linked annuity. Here to talk about that is my next guest, Charlie Gipple from Genworth. Welcome, Charlie.
Welcome, glad to be here.
All right, so when we talk about indexes and annuities, we're not really talking about buying an ETF for the Dow Jones Index or the S&P 500, right?
Right. We are not talking about direct participation in those markets. We're talking about a link, one's interest link to the percentage change in that respective index, for example, the S&P 500.
And how has the spike in yields recently affected the index-linked annuity market?
It's a little early to tell because the spike in yields, it happened abruptly over the last 7-week period of time, the 100 basis point increase in the 10-year Treasury. But when these were created in 1995, 1994 was the year that Fortune magazine called it the Great Bond Massacre. So these products are really designed for purposes such as what we experienced in 94 and similar to what we're experiencing today.
Can you give me an idea of how these index-linked annuities work, how people can get high, safe yield from it?
Yeah.
And certainly focus on the safe part.
Yeah, so the safety comes into where you have a floor. It's linked to the S&P 500, the percentage change in the S&P 500, ours are anyway. The S&P 500 drops 40% like it did in 2008. The client doesn't lose a penny solely as a result of that market decline. But if the S&P 500 goes up, the consumer participates in that up, or the interest linked is to the S&P 500 up to a cap, for example, 5%. We have a 7-year index annuity that has a cap of 5%.
And these are private contracts between Genworth and the client. They're not publicly traded, right?
That is correct.
So what's the liquidity? I guess that's what I'm getting at. What's the liquidity if you want to get out of one of these contracts?
Yeah, so we have a 5-year product, a 7-year product, and a 10-year product, meaning that that's the end of the surrender charge duration. But after year 1, there's usually a 10% penalty-free withdrawal that one can take out of their money. And if you wanted to, I could explain why we have those particular provisions on why they have to stay in for that long of a period of time. But yeah, 5, 7, 10 years with 10% after year 1.
And what about the costs? That's another sticking point for a lot of people when you talk about annuities.
Yeah, so when you think of costs, fees, first of all, our products don't have fees unless you add a rider to it, guaranteed lifetime withdrawal benefit riders, which are proliferating for reasons that we've seen over the last decade with the market doing what it's doing. But beyond that, our products do not have any fees. Fees mostly relate to the variable annuity business. They can be upwards of 3.5% or 4%. Our index annuities, they have the most prominent structure is a cap, say, of 5%, for example. Anything beyond that the market does may be considered an indirect fee, but it's caps as opposed to fees unless you add a rider that guarantees them that lifetime income.
So putting it all together, what kind of an investor should opt for one of your index-linked annuities right now?
One that is concerned about low interest rates, 77 basis point average on the 5-year CD. One that is concerned about losing their retirement money as a result of a negative 40% decline in the market like 2008. One that's also concerned with the bond market, or one that is approaching retirement and needs a lifetime guaranteed income stream. For example, if one's 65 years of age, we can guarantee that 65-year-old 5% withdrawals from their income value for the rest of their life, which, as you know, that's a little above the tried and true 4% rule that investment advisors utilize.
That is true. Charlie Gipple, thanks for coming.
Thank you.
And thank you for watching The Street.